Good morning. We are so happy to have all you here in sunny California. I can't get over this hotel. Elise has been telling us about it for 10 years, and it really is the prettiest place, I think, that we've had the event. So we always like to kick it off with the Revista data session. So we're going to do that today. I'm Hilda Martin. I'm here with Mike Hargrave, and we have three lovely panelists who are going to give us the boots on the ground insight into what's going on out there. You guys want to introduce yourselves and tell us about your companies?
Sure. Thanks for having us. My name is Ben Oakes. I'm CEO of Anchor Health Properties. We're a developer, manager, and investor in healthcare real estate based in Central Virginia.
I'm Eric Hill. I'm with Partner Valuation Advisors. I run our national healthcare and life science team, where we provide appraisals and fair market rent studies for everything in the healthcare vertical.
Griffin Torres, Senior Vice President of IRA Capital, or a healthcare real estate investment firm based out of Orange County, California.
All right. And Mike Hargrave with Revista.
So we've got sort of four key themes we're going to dig into today. And I'll be honest, when we were putting together this presentation, I got a little excited because the last however many quarters, 2 years, I feel like we've been telling a little bit of the same story, just activity's muted. There's not as much sales transaction activity. There's not as many construction starts. And for the first time putting together the data for this event, everything's starting to tick up. And I bet you guys have been sort of feeling this buzz since about the middle of last year, I guess, into the end of the year. And, we're putting the data together and looking backwards slightly at what's, closed, what's started. So it's exciting to sort of see that start to change and things to start to get that buzz going. But the four themes, we'll start with sort of, why we're all here. This is a really sticky sector. It is stable. We see occupancy staying high all the way back to the great financial crisis. We just don't see the same cyclical nature of other asset types. We'll dig into rent growth, especially right now with all the higher costs. And then construction, what's picking up? What are we seeing? Sales activity, what's picking up there? What's being bought and sold? So those are sort of the four key themes we'll dig into. So we'll start off here, the sustained demand. So our sector, everyone's always going to need healthcare. And not only that, but we've had a lot of tailwinds the last number of years because there's this shift to outpatient. All of the things that can now be performed in an outpatient environment that couldn't before. We've got the aging demographic. They need more healthcare services. There's more chronic conditions. So with all these tailwinds, you end up needing more employees, and employment growth in healthcare is the highest sector that the Bureau of Labor Statistics tracks. So they put out a projection for the next 10 years, and once again, healthcare, number one sector, growing more than 8% over that time period, which is a little slower than previously, but significantly faster than total non-farm. So currently, total non-farm has been slowing all the way to under 0.5% annual growth. Healthcare is still at 3%. So is offices of physicians and those employees. So growing at 3%, but our inventory has only been growing around 1%. So there's a bit of a disconnect there in terms of the amount of folks working in the sector and how fast we're growing the space. So they have to do more with less. And that's also, as you can see, pushing up occupancy, which it's been going up now since about the middle of 2021. Could be sort of stabling out here at around 92.5%. But this is the top 100 markets from the Revista database. And it's looking at that occupancy trend, and not only that, but what's being delivered and then what's being absorbed. So we've been outpacing deliveries for the past several years and continuing that upward trajectory.
So it begs a question for the panel here. You look at this graph, and really stability is one of the core tenets of outpatient real estate. So just in the current market, is investor appetite, do you guys think, is it recognizing this, and is it increasing, or is it decreasing, or like what's the current temperature, I guess, that you see out there? Maybe I'll start with Griffin and then just go down the line.
Yeah, I think it's definitely increasing. I think a lot of folks were on the sidelines for quite some time, and now you're starting to see capital sources, kind of come back. You're seeing spreads tighten on the debt side too, and so deals are starting to pencil more when they weren't previously.
Mm-hmm.
I have to agree. I think, at least in our business, we see a whole lot of transactions across the country. And, over the last few years, you typically have your traditional players who are focused on healthcare, but more and more we're starting to see outside investors who are focusing more capital and allocation to the healthcare sector. And it's definitely increased their appetite as they see this as a very steady asset class that they can invest in.
Mm-hmm. Okay.
And we're certainly seeing interest from new capital in getting into the space. It's been essentially 3 years in the winter, I think, for the sector, as folks have chased AI and other types of high growth real estate sectors, particularly more residential related. I do think thematically we're seeing some investors say, how can we be a little more defensive with our allocations after getting some of the lift that they have the last 3 years in other sectors. And then also those who are tracking Odyssey, MOB is still under office. And so if you are tracking or benchmarking to Odyssey and you don't want to go fully in on office, you can get some allocation to MOB and still kind of fulfill that requirement. And then, of course, thematically, we're in the next 5 years, we're going to be 22% of the total population in the U.S. is going to be over 65. And I think the data is that those who are 65 and older are 3 times more likely, to need to see a healthcare provider. So you start looking at those circumstances, and I believe that investors are right to consider an allocation to the space. You get a little more defensive mindset, yet I think you're going to have some tailwinds of resiliency.
Yeah. Yeah, it's interesting. You mentioned defensive, and I think that's a point that, when investors look at the space, they think, if we're heading towards a recession or if we're heading towards a downturn or something, healthcare real estate is really a great place to be. Is there any of that kind of thinking in those decisions that you might see out there?
I think, for each investor, it's different. But when you're looking at portfolio construction and allocation, I do think that is a consideration of how much alpha are you chasing and how much beta. I think the sector's proven out its long-term effects of it's slow and steady, and there's good and bad to that. I think in general, when it's been good to be a bond investor, the sector has done well. When it's not been good to be a bond investor, or when bonds haven't done well, then I think we've struggled versus other sectors.
Yeah. By the way, just for those of you that might be interested, we have our Rising Leaders Council here at Revista, a bunch of young guns, and they put from time to time out white papers. There's a brand new white paper that I think is getting posted today to our website. It's under free resources and white papers. Sophie Kim from Rethink Healthcare authored it, and it's all about the risk-adjusted returns that the sector offers, really relative to other sectors and how the Sharpe ratios are, like better than other sectors. So very insightful. Recommend everybody download it, and it should be really good. So okay.
Definitely.
Yeah.
So when you have occupancy that's getting higher and higher, market by market, some of those occupancies are getting so high that it's really creating pressure within those markets. It's more pronounced in smaller markets. There's fewer construction projects. There's higher occupancy. So I didn't want to just show you the 10 smallest markets. So I have here any market that's over 1 million people. It's a little more than the top 50, and those ones that have the highest occupancy and showing their completions as well. So what you can see is a lot of these markets have nothing being delivered or very little being delivered. And when you have 5% or less availability in a market, a lot of that is obsolete. It's not something that you could necessarily lease, and that creates a lot of pressure in those markets. So we're in California, and I can't not mention California markets. All of the markets we track in California are above average occupancy. You'll see a few of them on here, and very little construction. So about 0.4% of inventory delivered in the last year in California. So all of these dynamics are pretty pronounced locally here.
Okay. Maybe another question to roll along the panel. You know, when you're looking at markets, what kind of general attributes do you generally see or look for, or you see other companies looking for that you notice in these markets? So just put on the line.
I'll kick it off. Yeah, I think for us, we really focus on the fundamentals from the macro level. Obviously sources like Revista, we get a lot of good supply-demand information, and so we're looking at overall absorption, new starts, to kind of dial in not just today, but forecast what occupancy is going to look like down the line.
Yep.
And then more so at the micro level, we're looking at the hospitals that we're aligning ourselves with, digging into their financials, overall credit profile, making sure that there's a going concern, and so that's kind of how we're triangulating things today.
Okay. What are you seeing, Eric, out there?
Yeah, when we're looking at markets, it's really who wants to be there? Why are people going to one market versus another? We see a lot of growth in the Sunbelt areas as people start to retire and move out of high cost of living areas to where it's nice and sunny and warm. You want to look at what health systems are there and what kind of support structure are there to support patients and population base. Cost of construction, other employment-based sector jobs that are there to, boost the population. And it's just, comparing one market to another, they can be very similar or vastly different, obviously. Here in California, like you said, it's constrained with construction. That's due to a lot of regulation here in the state and having to build in a lot of cost to get something out of the ground. But then you go to a more economic climate that's a little more forgiving, and you can get something built very quickly at a much cheaper cost. And that's tend to be places where people are starting to congregate.
Yeah, generally we're looking for markets where there's good growth, and by default that generally means coastal markets and Sunbelt. And I think within that we're looking at the of course, constraints on new supply. And so some markets that may not have as much growth, it may still be challenging to get projects out of the ground, and there's certificate of need protection and so forth. And that can give you a lot more comfort as an investor. Alternatively, markets like Florida, where they've done away with CONs, it's been red hot for a few years now in terms of new supply, but I think arguably they're still short. And they still need more. So then I think you're putting on more of a traditional real estate investor hat in terms of measuring supply and demand, and a little more scrutiny on the exact location to make sure that as more supply, more supply is coming, is that investment still going to be sustainable with more supply that's coming down the road with a lot less barriers to entry, for example.
Interesting. Okay. All right, I'm going to go over a few slides here. So this is a slide that shows the average base rent across several percentiles that we track in the Revista database for the top 100 metro areas. So the red line is the 90th percentile rent. The gray or black line is the 50th percentile rent, and then the 10th percentile rent is the teal or blue line, I guess it looks like to me there. And the point here is that when you look at these three rents, generally they trend in the same direction. And they were doing so, all the way up to 2021. But really since 2021, you've seen that the top tier rents are kind of taking off. They have obviously a faster CAGR than the mid-tier, which has a faster CAGR than the 10th percentile trend. And this is something that we've seen really in a lot of the markets, and I think it says a lot to us. So.
Yeah, so with these top tier rents moving up faster, are you using that at all in your strategy across your portfolio to boost rents? Are you taking that into consideration?
I'm happy to chime in. We have not broken it down in this manner, but I do think what this chart reflects is essentially high quality product demands a premium. I think as an investor, you've got to be willing to put money back into the facilities to maintain them. And I think we have seen when and where we've followed that thesis of investing back in the facilities that it's retained tenancy and attracted tenancy. Not to say that $40 a foot, that tenants want to pay $40 a foot, but I think if you're bringing strong product and it's well located, that versus other cost elements within the line item expenses of a provider, this is something that they're able to make work within their numbers. Generally, rents are around 7 to 9% of total expenses within their expense line items. So that is something that is manageable if you've got enough of top line revenue. Generally, we're seeing the specialists and higher acuity type users pursue the higher quality space. Where we're seeing the $25 a foot rents, I think much of that is just what's already in place, kind of your typical MOB clinical space around the country. Folks like primary care providers, I think that they need to stay within that range. They're not stretching for the nicer space for the $40 a foot. We are at, I think, a really unique time right now that I at least haven't seen in the past 20 years in this space, that if you're an investor today and you're buying in and you're getting a basis of around $25 a foot net rents, replacement costs are every bit of $35 to $40 a foot, and in many cases going over that. And so it does give you the opportunity to push leasing spreads on renewals in ways that this sector has never really experienced before. So I think that's neat. That's unique to us right now. I also think that there's potential, I'm sure we'll talk about it, of cap rate compression in the years ahead. I think we're actually seeing some of that over the course of the last 12 months. Not a bad time to get in from a basis play in the sector.
Yeah. Isn't that really, I mean, you're outlining one of the most strategic kind of value add opportunities that organically exist in this sector. It's not taking necessarily buildings that have, occupancy issues. I mean, there's opportunities with base rents out there to really capture kind of what current market rent is. Are you seeing that? Are you seeing investors chasing that strategy? Or?
Yeah, absolutely. I mean, we see investors come in and immediately start to push rents in markets where there's, the elasticity there, where traditionally the prior owner or occupant hasn't kept pace with where the market is and what various providers and tenants are willing to pay. I think this spread is definitely reflective of two different things. One, the cost of capital and construction. To get something out of the ground, it takes higher rents. Everybody can see that. But also, it's a flight to quality. Like Ben said, when someone comes in and reinvests in a building to upgrade the amenities, historically doctors tend to have a little bit of an ego and want the new shiny thing and are willing to pay a little bit of a premium in order to get it. And so when you have a new building or new amenities added, rent's got to go up, and depending on who the doctor is and what their specific field is, they're willing to pay for it.
Okay. Griffin?
Yeah, I agree. I think it overall represents the flight to quality, but I think it's also, as we see more high acuity cases move to outpatient, right? The overall construction cost is going up. You're seeing a lot more ASCs, oncology centers, right? I think that's where probably a lot of the higher rents are reflected. And then also, to echo what Eric said, the overall construction cost as of lately, right? And the yields, just given the financing environment we've been in over the past couple of years, I'd say that it's expected to see that discrepancy, right? And I think on the lower end, right, those are your lower cost occupiers. Maybe, you're seeing users who are a little less sensitive to being in an actual medical building today, right, where there's a glut of regular office space. Maybe I can just slot in there, invest some nominal TIs, and that's where you're kind of, I think, on the lower range.
Okay. All right, you mentioned construction costs. So this is one of the most requested charts we get at Revista. This is used in discussions with hospitals all the time. It shows the existing, average triple net rent for existing MOBs. That's the red line. And the black line is brand new MOBs. So it's MOBs that are 2 years age or less, their average rent. And then you can see the spread is the gray area there, the spread between the two rents. And you can see that the spread has been growing. I mean, this reflects the higher construction costs and also higher yields that developers need on newer MOBs, and so they've been pushing those rents higher, and the gap is $1.29 as of the end of 2029, and that gap just keeps growing, and so this has been something. It's been a conversation that developers have been having with hospitals and different tenants out there. And it's one of the reasons that construction has slowed, I guess. So.
Yeah, I mean, this is why we've seen such a pullback over the last several years in the amount of construction starts. It's creating all that supply pressure. How is that being navigated, that sort of delta between what you have to charge for those rents and how much it's costing to build? And how are, a lot of people are getting past that now because we're starting to see things tick up.
So I think this sector has benefited from limits on supply. As an investor, it has benefited from limits on new supply due to various reasons. Some of them are regulatory. Some of them are, for example, cost of construction. And so it really has kept out speculative product. The carry cost on building and having an empty shell there is extremely significant. Much harder to build spec in this space than other real estate sectors. I think what we're seeing is essentially those who have such conviction in their business model and their growth strategies that their own returns, health system and health provider returns are significant enough where they're able to justify going out and building new product. And I think to their benefit, generally what we're seeing, we've noticed trends in the MOB space where health systems know that in large part their balance sheet is being used to fund the transaction. They go run a competitive RFP and it basically becomes a build the core strategy. And bidding rent constants down to really unbelievable numbers, and yet it still is resulting in extremely high construction costs. We are also seeing thematically under that strategy more health systems that are and health providers who are asking for full tenant improvements. And of course that makes it a challenge for us too. How can we make sure that we're solving back to market rents? And so in those instances, we're often applying a discounted net present value to above market rent just to make sure that we're able to have some sanity check on the numbers and balance it out to market at the end of the day.
Yeah, no, Ben, that's exactly right. When you look at, I think we're in an environment where as the population continues to grow and age, and we've got high occupancy in the existing product that's out there, you have to build or you have to convert. And in order to do either one, it costs a lot. And it's not so much that they want to pay higher rent, it's that there's really no alternative at the moment. It is what it is. in order to get a product that provides for the patients and the population in the local markets. I think what's interesting on this, this big chunk of OpEx, is probably driven a lot with taxes for the new construction. Obviously, the local assessor is going to know what it costs to come out of the ground and is going to be happy to send you a tax bill for that.
We don't show this chart to assessors, so.
You shouldn't. But then also the insurance costs have gone up, especially in the coastal markets. And all that gets passed to the tenants on a triple net basis or an absolute net basis. But Ben, like you were saying, if you're in a market where you come out of the ground and the rent is extremely high, I think there's two ways to look at it. Either you have to compare it to other, brand new construction where that is market rent for brand new product, or if you're, looking at existing product, having the net present value and discounting it back of the above market rent. Really, that's how we and a lot of lenders look at it to make sure that if that space were to go vacant, what's it gonna, re-tenant for, down the road, and really hedge the risk that way.
Yeah, I think I generally agree. I think too, another trend we're seeing is, and I think Ben had mentioned this, but a lot of the health systems and other users kind of want the turnkey solution. Mm-hmm. And so you're driving a lot more cost into your overall budget. And when you apply a yield there, your overall rent's going to go up, right? And so I think, we're seeing that not only on, kind of ground up, but also in just standard TI jobs, right? And what the allowances that the tenants are asking for. And so, one way where we're trying to get creative is, hey, maybe we amortize some of these costs back to the tenant. And so, on our exit, right, we're not looking at some crazy rent that's above market and going to get dinged there. So I think that is generally how we're looking at it, but I think we're going to see the trend continue. I mean, luckily, I think, financing rates are coming back in a little bit, so the yield should continue to drive down. But with construction costs where there are, I don't see this chart moving in any direction other than up. So.
Yeah. Hilda, do we have the ability to do questions from the audience, or?
Yeah, absolutely.
So if anybody has any questions, just raise your hand so we can notice you. And I think there's a microphone floating around somewhere. So.
Okay.
Okay, next slide, I guess. Yeah. Okay, so last slide on rent. So this is the Revista regions that we track. We have the East North Central region, which is, I've got some metros next to it. You see, I think they're the three or four major metros in each of the regions. You can see their average triple net rent as of the fourth quarter of 2025, the 90th percentile rent, and same store year-over-year rent growth. So, very different conditions, across the country. Obviously, Hilda mentioned the highest rents are on the West Coast. That's the Pacific region. Northeast also has higher rents as well. Maybe some of the higher growth is in the Southeast, Southwest, kind of areas. The Mid-Atlantic is always pretty strong, has, the 90th percentile rent's pretty high as well. But it just highlights different kind of, strategies that different, owners and different stakeholders can pursue out in the country, rent-wise.
So we talked about markets a little bit earlier in terms of fundamentals, but do you take into account sort of the costs in a particular market, the rents, the rent growth that we're seeing? Does that sort of play a factor as well?
I think in each one of these markets, we want to make sure that we've got comfort in the future demand profile and in the health, so to speak, of the trends that we're seeing in the market. Looking at this slide, just the Pacific triple net rents seem pretty low to me versus what we're historically seeing. In our own data, I think we're seeing escalators as much as 4% right now on the renewals that we're getting, and we've generally seen 7% leasing spreads on renewals over the course of the past 12 months. So I think that some of this may be, is obviously market specific, but as I mentioned earlier, overall, the growth that we're seeing in both base rent as well as escalators is pretty significant across the board right now.
Okay.
Okay.
Yeah, I think when you're looking at markets, it's very important to know exactly who your competitors are and how the asset you're looking at versus your competitors and how they compare. Because, you look at the rate and spreads, especially in the Pacific market, going from 22.22 to 53.20. Obviously, those are not comparable buildings, if you were to look at them on a building by building basis. And so, traditionally, across most markets, when you start to dial in within a 3 or 5, 10-mile radius, we're seeing pretty steady 2 to 3% growth for most sections of the country. But it's very important to dial in and know exactly what you're looking at.
Okay.
Yeah, I agree. I think we've probably acquired assets in most of these markets over the past kind of 12 to 24 months. I think to echo what Ben had said in the Pacific, especially in Orange County and some of the other markets where we have assets, we're seeing the 3.5% to 4% increases. And tenants not really pushing back a whole lot. I think in other markets we're seeing 2.5%, 3%. Been pretty consistent with 3% over the past year. But yeah, I think it also just reflects generally to where you're seeing new supply most, right? I think, Southeast, you're seeing a lot of new supply. Probably call it the East, North Central, where it's more so the Midwest markets. You're probably seeing less. So I think that's why there's kind of less spread between the average triple net and the 90th percentile.
Yeah, new supply can actually drive rents in a market, and it's healthy for rents in a market. So that's a good point. So, okay.
Yeah. Okay, let's move on to construction. So overall in construction, a lot of the trends that we're looking at is basically was adding square feet. So if it's just strictly a renovation, that's not included in these stats. What you're looking at here is just third-party developers. But overall last year, including what hospitals and systems and provider groups are developing as well, we started 17.9 million square feet. And in 2024, it was 16.2, so a solid 10% increase year over year in what we started for outpatient space across the US. So definitely starting to see an uptick. It's not where we were pre-pandemic. Pre-pandemic, we were often starting 25 million square feet or more in a year period. But we're starting to see things come back around, which is exciting. And this is just third-party developers. So we track third-party developers. Some of them own the project, and some of them are just fee-for-service, but most of it is owned. And this is looking at just what they start on an annual basis. And last year, they started 5.5 million square feet. That's up 23% from 2024. So a lot of this uptick is third-party developed activity. And it is focused regionally. There's Southeast, Southwest, as we were just talking about, but a lot in the Southwest last year. Over a quarter, which is mostly Texas, over a quarter of what was started was in that area. So just exciting to see this pickup, and definitely a meaningful increase in 2025.
Yeah, our slides were always, when will construction activity pick up? Now we've changed them to construction activity is picking up. Yeah. So we're finally seeing things pick up. Griffin, what's changing on the construction side to allow stats to start to pick up, do you think, in the last few quarters?
I think main reasons are I think there's more capital coming off the sidelines, coming back into play. I think overall financing spreads have come in, right? So
the debt side.
The debt side, and you're seeing more lenders coming back into the space. So I think that's a big part of it. I think also, to Ben's point earlier, I don't think there's a whole lot of I can't imagine much of this is speculative, right? And so it's the health systems now starting to understand what their long-term goals are, and working with the developers to kind of put the shovel in the ground, right? So I think we're seeing more of that now that we're kind of coming out of the COVID era, so to speak.
Yep.
Yeah, I think a lot of it has to do with population change. The Arizona, Texas, Florida, a lot of population influx. And as the population grows, you have to keep up with the demand. And, a lot of systems, in those 3 states are kind of at capacity in their existing facilities, and they have to come out of the ground with new product or heavily renovate an existing building. And, whether it's a third-party developer or the hospital develops themselves, it seems like most hospitals go with a third-party developer just due to the expertise that the developer has and the speed of construction and trying to keep costs down. But for us, we see a lot of population influx driving this number.
And what I would say here is that I think this is indicative of, remember there's a lag time when you're planning a project and how long it takes to actually get to a start. And that's often 18 to, in some cases 36 months or longer. And so when we're seeing the low point in Q4 of 2024 and Q1 of 2025, that's really from where the health provider environment was a few years ago. I think if you talk to other developers around the conference, and we're seeing this, our pipeline is as full as it's ever been, if not greater than it's ever been for new projects. And there's a lot of demand there. I think that health systems are now out of COVID, and we've got the have and the have-nots. Certain projects were shelved. I think that others were just put on hold, and I think that we're seeing some catch-up there. I think that also we're going to see, my prediction would be that we're going to see a lot more starts as a result of private equity joint venture operators affiliating with health systems to pursue certain strategies. That often accelerates a project as opposed to a health system on their own saying, we need a new building here. If there's someone who's driving it and instigating, the demand case for it, it does bring more of a sense of urgency, and that's a theme that we're starting to see as well.
Okay.
So it sounds like the crystal ball is this trend's going to keep going up.
Yep. Yeah.
I like
Yeah,
that.
barring something crazy happening geopolitically or otherwise. Yeah, it's, we're on an
Indeed.
upward.
Which can happen.
Yeah.
You never know.
All right. So sort of playing off what you're saying with health systems, a lot of this uptick, this is essentially the same thing, third-party starts, but are they doing this project for an independent physician group, or are they doing it for a health system or a hospital? And it's definitely been a pickup, the amount of hospital health systems utilizing a third-party developer. Of the 138 projects started last year by a third party, 100 of them were affiliated with a hospital or health system, which you can see is a bigger increase and a bigger share of what they're starting. That tends to be off campus. So 75% of that has been off campus, whereas if you looked at the hospital-driven projects, they're more like 50-50, so they definitely prefer to drive their projects on their hospital campus, and they're more open off campus. But generally, we're seeing this start to uptick.
All right, I think we covered the questions on
Yeah.
this. Let's go to the next slide.
All right, so slightly off this theme, but have to sort of bring it up with this group. We've seen over the last number of years behavioral and rehab hospitals growing in terms of new construction and also acquisitions. So last year for inpatient rehab, it was the highest year for acquisitions since pre-pandemic. And there's a lot of demand tailwinds behind these. You've got your inpatient rehab facility, your IRF. You've got folks who are in a general acute care hospital having a stroke or some sort of really complex illness. They're going out to this sort of in a post-acute fashion, and the older the population gets, the more these types of events are going to put them in a stay in an IRF. So it's interesting to see this pickup over the last several years.
Yeah, we've seen tremendous growth on the, particularly both of these sectors, but just talking about the IRF side, CJ Kodani from Colliers just posted a blog on this, so check it out on the Revista site. I think he said there's something like that. That's the freestanding IRF sector's grown like 67% over the past few years. I mean, it's just tremendous growth. So really I mean, you can't build rehab hospitals in every single state out there. Obviously it's restrictive in some states, but what's driving this just tremendous growth that we're seeing out there?
Yeah, I think, on the freestanding side, when you look at hospitals, right, they're pretty space constrained, right, land constrained. So there's not a whole lot of opportunity to expand on campus. And I think, especially with, rehab hospitals, it's all about patient convenience, right, and being in the actual, closer to where they live in the suburbs, right. So I think we're seeing a lot more of those. I think just kind of anecdotally, even driving around, you're seeing them kind of pop up where, before it was always on the hospital campus. And I think on the capital market side, I think, from an investor standpoint, IRFs and behavioral hospitals, they offer a lot more yield. And they're often, long-term leases, solid rent increases, right? So there's a lot to like. And I think the stat was, it was, Newmark and Revista data was like 550 million of IRF transactions last year, which was up, from 480 or something like that the year before. So we're seeing a lot more appetite for them, which I think is also, prompting developers to go partner up and, work with these operators to build more.
Okay.
Yeah, on the IRF side, obviously a lot of technologies in the healthcare sector have allowed for more ambulatory surgeries where you're in and out and can go to a post-acute facility for the continued rehab and getting back to your home. We saw a lot of transactions over this last year with a Clear Sky and PAM and Encompass in the IRF space. On the behavioral side, I think the stigma around getting mental health treatment is starting to vastly decline in the country. The willingness to actually go to the facility, receive the treatment, but also for the insurance companies to actually pay for it now has gone up and continues to get more and more traction. In the behavioral space, you have both kind of the psychiatric and the substance use treatment side of it, and both we've seen a large uptick over the last kind of 12 to 24 months, and not only people wanting to use it, but also lenders and investors being more comfortable within that space and realizing it's more and more of a mainstay within the healthcare sector. And like Griffin said, the yields on them, they typically trade at a little bit higher price point than your institutional medical office, and so there's a little more yield to gain on those properties.
And I would note, I think both behavioral and inpatient rehab have benefited from better reimbursements post-COVID versus pre-COVID. CMS has certainly come a long way in how they're structuring payments for those services. Honestly, I'm surprised that we're not seeing more volume for the rehab hospitals based on what we're seeing in the market today. I would tell you, I think that there's going to be a lot more growth in that space versus behavioral health on the go forward. And behavioral, even though reimbursements are better, it is still a very difficult business model. It's a hard model to staff. And so it's somewhat surprising to me to see the sustained volume that we're seeing on that front.
Yeah, and in reality, the rehab hospital industry in general has done a great job over decades of investing in outcomes research. Mm-hmm. And I know, CMS has noted that in some of their transmittals. And I think they've benefited, they're going to argue with me on this, but I think they've benefited from a better reimbursement risk profile relative to other post-acute class, mm-hmm. Asset classes that you see out there. And so I would agree. I think there's a lot of growth opportunity in that sector. So
yeah, Mike, I agree. I think the IRF has really taken a big chunk of business out of what the LTAC used to offer,
right.
Especially with the reimbursement change that happened about a decade ago.
Yeah. All right, transaction time. Okay.
Best for last.
Yeah, last few slides. All right, so transaction volume is picking up. So it's interesting. It's first slide we've had in a couple of years on that. So this is a slide that shows the single property transaction volume along with the portfolio transaction volume. And we've seen, a couple big portfolios starting to close just towards the end of the year. That's driven the portfolio volume up in the fourth quarter of 2025. In all, right now, the fourth quarter in 2025 data is very preliminary. It'll move up from here as we catalog more transactions. But you can see that already, we're generally trending up, both with regard to portfolios and with regard to single properties. Single properties, established a low about a year ago. Single property transaction volume. That's the black bars. And portfolios are obviously picking up right now too. So it's very encouraging for all of us in the room. That transaction volume actually is picking up now.
So Ben, Anchor is really focused on individual property transactions that are strategic acquisitions. What are you seeing in the market? I mean, that's obviously upticked as well as portfolios. Is there a lot more investor interest and demand that you're seeing?
Yeah, I think portfolios are back. Historically, we have operated in more of a rifle shot approach of carefully curating a portfolio that we want to own rather than buying a basket of properties and having to then parse through it afterwards. But as we've seen capital coming back and that capital needing to get placed generally in large positions and oftentimes with some time constraints surrounding it, it does lead to portfolio acquisitions. And I think on a recent CBRE investor call, I heard that they were pegging it at a 25 to 35 basis point cap rate compression or premium, really, that they were seeing for portfolios. And it's been several years since we've seen that occur, that there is actually a premium for portfolio acquisition. Some of our own data that I'll share with you that I thought was interesting, we saw 94 single asset trades in Q4 2025. That was up from 79 in Q4 2024 and 70 in Q3 of 2025. And then also another interesting stat, in 2025, private equity buyers versus 2024, we saw 95 new buyers in 2025 who did not make a purchase in the space in 2024. So a lot more activity, a lot more portfolios that are in the market right now and that we understand are coming to the market. And I do think a portfolio premium is back.
That's exciting. Exciting to hear. Griffin, you just had a large deal close. Is there anything you can tell us about that and what you're seeing in the market?
Yeah, so we actually just closed on two portfolios, combined at roughly 40 assets. And so I think the one that you're referring to is the 24 asset portfolio that we acquired in December. And I think, what we're seeing in terms of the portfolios is, I think there is some portfolio premium, but I think in the kind of asset class that we're playing in, where it's a little bit more core plus value add, I think there is still a little bit of a discount relative to the sum of the parts. And so I'm actually curious to hear what Eric's seeing when he's doing, because on every portfolio transaction, right?
You want to show the portfolio slide?
You're appraising assets individually, right?
Right.
And so where is that kind of shaking out to on an individual, sum of the parts basis versus the overall portfolio purchase price?
Yeah, historically, like Ben and Griffin have noted, there has been a historical kind of portfolio premium that you see when you look at it in aggregate, due to the placing a large chunk of capital at one time, saving on, attorney's fees, closing costs, brokerage fees all at one time. You get a little bit of a higher yield doing that, and 25, 50 bips, 2 or 3%, kind of overall transaction value. But when looking at it on an individual asset basis, it drops off a little bit. But over the last 12 to 24 months, there's almost been a portfolio penalty. It seemed like, there's almost, a point in time where, we never saw a portfolio come across our desk that was more than about 50 million, maybe 100 million, just because it was so capital constrained and the lenders just didn't want to get into it. But it seems like now, especially in the fourth quarter, with the large portfolios that did take place and a lot of syndication that's happening now on the lending side, the capital's starting to flow a lot more easily and people are a lot more comfortable with where we're at in the current cap rate and cost environment.
Yeah. Yeah, it would make sense. I mean, like you can see what Eric's talking about there, that back in 2023, 2024, there was no portfolio premium. I mean, there was actually a hit, I guess, for portfolios. Too much risk, I guess. But, you know, it's come back now. And obviously, single properties, you know, they trend how they're trading. But, you know, we see this attraction toward portfolios, building scale. There's, you know, we see on our side, we see a lot of capital that is really looking at the sector right now. And, you know, one of their big issues is just supply, you know, is there enough supply out there? And I think, you know, the portfolios can kind of get you that going, you know, can't they?
Yeah, and the other thing is that lenders have, you know, opened up their wallets again to be in the space. Particularly, I think thematically, we saw that in 2025, which I think has helped to fuel this. Mm-hmm. They're willing to finance larger portfolios. They weren't, you know, during the last couple of years. Yeah. So I think that's really helped. And yes, I think those who want to have a position in the sector, you know, there are some investors who need to put big checks to work. And as I shared earlier, if you're buying in and your basis on your rents are $25 a foot and new builds are $40 a foot, I don't know that it's the worst thing to be making, you know, that bet right now in the market by taking a large position. I think you potentially have some good tailwinds.
Mm-hmm. Okay.
I think the portfolio is also, you know, when you're trying to place a large chunk of capital, it allows you to diversify either geographically or by asset class, because we've seen both where it's either spread out across the country and or you also have kind of the MOBs and the ASCs and the IRFs all kind of mixed in that help create a balanced portfolio that can get you into the market in a good position relatively quickly.
Okay.
Okay. In terms of pricing, is everyone sort of coming to a meeting of the minds now, or do you still feel like there's any of that mentality of what folks were getting in 2021, 2022? Is that sort of, it seems like sellers and buyers are sort of coming together now a little bit more.
I think we're seeing real-time cap rate compression. We're not back at 2021 and 2022 pricing levels, but we certainly are seeing rates moving over the last, or strike prices essentially moving over the last several months. I think we are set up to continue to see that trend in the year ahead.
Okay.
Yeah, I think the bid-ask spread has definitely narrowed as we've been in this kind of same climate for a longer time. I think the spreads on capital costs have also narrowed here recently, and I think, you know, especially with the naming of a new Fed chair and seeing what happens throughout this year, if the Fed continues to make downward position moves on their rates, it could really fuel what's happening in 2026 long term.
Yeah, I agree. I think, you know, we're definitely starting to see cap rates come in, especially for more of the kind of core down the fairway credit product. I think there's a lot of groups chasing that. And so you're seeing, you know, stuff, you know, in the fives, whereas before you were seeing kind of everything, the floor was kind of in the low sixes, right? And I think also, you know, when you're looking at a mark to market, if you're at $25 and, you know, there's a fair market reset, you can get a pretty solid gain. Your stabilized yield on cost when you mark that rent to market, even if you're buying in the fives, right? You might be able to get up to 6.5, 7, right? So I think that's something that we're seeing too, which is just reflective of the overall increase in construction costs and where in-place rents are.
Yeah. Okay.
Okay, so this slide shows the average cap rate, 7.2% right now, against the 10-year Treasury. I think as of the fourth quarter 2025, it was 4.1%. It's a little bit higher right now. It's ticked up a little bit in the first part of the year. Then you see the spread. So the gray part is is the spread between the two rates. So, I mean, the spread's all over the place. It shows they're not necessarily correlated, I guess. So there is a little bit of a correlation here. But you see right now that the spread is about 300 basis points or so. But to me, what's interesting is, we were seeing a lot of volatility back in 2022, 2023 with regard to the Treasury rate. And it, caused a lot of shock amongst, particularly the lenders, I guess you mentioned, Ben. But, the environment has kind of smoothed out, over the past year and a half. And we're seeing, like even though rates are a little bit elevated to where they were, we're seeing a more stable capital markets environment. And so that's like, is that going to create increased activity, I guess? So.
Yeah, what's your crystal ball?
I certainly think that it's been good for lending some predictability to the sector, and I think that folks are more convicted to transact as a result. So I would say it's absolutely helping the market at this point.
Mm-hmm. Yeah, I think there's definitely been some comfort and realization that we are where we are, and there's not going to be giant swings, in the near future. But I think there's a lot of hope for 26, and that'll fuel us with a lot of transactions this year.
Yeah, I agree. I think, even if short-term rates continue to come down, we also need to look at kind of the longer term, which, this obviously shows. But, I think as much as the rates have kind of stabilized, I think we're also seeing, the overall spreads come in. And so you're seeing now, positive leverage a lot of the times, whereas before, you maybe needed to chase more core plus value add to get that. Mm-hmm. And so now, I think that's something where you're seeing a lot more appetite, which is why we've seen a ton of transaction volume over the past quarter.
How about the sellers? Like you saw, maybe investors that bought buildings back in 2019, 2020, 21. Their fund cycle, is kind of coming to a close here. They bought at a much lower cap rate than is out there right now. How, there's been this why should I sell, sort of environment. Is that lifting at all, do you think, or is that waning?
I think if you just kind of look back at 21 and 2020, more so 2021 now, but a lot of folks place 5-year debt, right? So now they're kind of up against the clock in terms of, hey, what are we going to do? Mm-hmm. Call it 6-9 months down the line, right? And so I don't know that they're necessarily forced sellers, but like, hey, if we can pick up, some sort of gain, just given that there was rent escalations, or maybe we picked up on occupancy, or you can sell, the mark to market, right? Mm-hmm. On a go forward basis, you might be able to, still eke out a win there.
Yeah, we see it in our data that, we have like a same store sales pair, mm-hmm. and we do see, like the overall gap, there's more properties that are selling for about the same price that they sold for back in those days. Not all of them, but some of them are. So Are you seeing that out there too, Eric?
Yeah, I mean, we're getting closer and closer to kind of historical pricing. We're not there yet, but it's getting better. And I think, of those people who bought at a lower cap rate and are now having to transact for a variety of reasons, some of that higher cap rate spread has been offset with rent growth throughout the years, mm-hmm. Which is, a positive factor of the healthcare sector. I mean, it's slow and steady for the most part. But it's also an opportunity if they, once they get out, they're able to get into another market where there's a lot of opportunity. And especially with hopefully where we think rates are going to go in the next 12 to 24 months, a lot of upside looking at that as well.
Okay.
Yeah, and I think those who may have paid a more aggressive cap rate versus what they could sell it at in theory today, I do think underwriting in general presents the opportunity that there's higher escalators and higher mark-to-markets, which probably is a saving grace to allowing them to basically get back to par or maybe slightly better, even though the cap rate may be different.
Yeah. All right, we have a couple more questions saved up here, but wanted to stop. Is there any questions from anybody in the audience? I mean, we've got 3 esteemed panelists here, and Hilda knows her stuff inside and out. So, any questions at all?
Well,
Burning on your mind or anything? No?
I think we just did such a good job answering everything.
Did we solve all the world's problems? No? No? Maybe 3% of them? So what about, asset types, I guess? We were talking about, I guess this time last year, we were talking about to get deals done sometimes you have to consider, like, particularly on institutional grade product, you might have to consider, potentially negative leverage going into a deal. What about, what kind of asset types are seeing the most interest right now from what you're seeing out in the markets?
I think for us, kind of you're just down, for what we're looking for is kind of you're down the fairway, MOB, right? I think, again, a little bit of a core plus flavor to it, just so we can, kind of hit the return profile we're targeting. But I think overall, based on what we're seeing, there's a ton of demand for the more kind of core assets, right? Like, just because we try and follow the market, but, you're seeing anything with credit, long-term lease, and decent escalations in place, it's, there's a lot of bidders out there, and, price is really getting aggressive.
Yeah, I mean, traditionally it's your core on-campus, campus-adjacent, institutional-type property. We're seeing a lot more activity in the behavioral space. Obviously, IRF is having an uptick. Also seeing a lot of activity in more tertiary markets where there is a decent regional health system that has a good balance sheet that is going to be around and operating for a good long time. Especially in the Sun Belt where more and more people are starting to move. Those tertiary markets have a lot of growth potential and some good yields to them.
I think that the best assets are the ones that have high acuity yet still in an outpatient setting. They've got some scale to them, so call it at least 60,000 to maybe 100,000 square feet. They're health system sponsored, long-term lease, good major metro market, and if you've got 3% escalators, in that range, that's kind of right down the fairway, and I think it's best pricing in today's market.
Good deal.
yeah.
All right, we got one more. I got one more question. Any questions out there at all? Yes, ma'am.
With outpatient demand staying strong, are you seeing more medical tenants prioritizing high visibility, high activity locations like retail corridor, mixed-use developments over traditional MOB settings? I could repeat that.
Yeah, go ahead and repeat it, yeah.
With outpatient demand staying strong, are you seeing more medical tenants prioritizing high visibility, high activity locations like retail corridors and mixed-use developments over traditional MOB settings, and what does that shift mean for leasing and development decisions? My name's Rosanna Bio, and I'm with Gerard Construction.
Thanks, Rosanna.
What we're seeing, urgent cares and the like certainly need a retail presence, and they're willing and able to take down the cost of a retail pad site. Traditionally in MOB, our cost per square foot on land is usually at a discount versus what you would see in retail. So with more of an urgent care or maybe a freestanding emergency department, that they're able to absorb some of those retail costs. Then you've got situations like a primary care group or a pediatrics group. They're going to be a lot more price sensitive. And so I think that they don't necessarily need to be in an MOB. It's not as high acuity. They might be. But they're more of a lowest cost environment is really what they're looking for. And so I think we're more seeing the stick-built kind of Class B or Class C type opportunities for them when they're more price sensitive and having interest there. The higher acuity specialty spaces, generally we're seeing them want to be in an MOB, and not so much a focus on like having a retail location.
Yeah, I think it definitely depends on what the medical service being provided at that facility is going to be. Like Ben was saying, the higher acuity operators, your family practice, those are all destination locations, so they don't really need the retail setting and the traffic count. Some of the FSEDs, the urgent cares, maybe blood draws like a LabCorp type deal. Those can be a little more retail, but usually, kind of a med-tail scenario, sometimes it works, sometimes it doesn't, depending on the tenant mix and what the other retail tenants are versus the medical tenants. And parking, can be an issue, in those locations as well. And so it really just depends on who's looking at the space, but I don't know that there's a definite demand for the retail location for most medical tenants.
I think there's a lot of hospitals, though, that are out there, particularly in, it seems like mostly interior markets where there's vacant, Kmarts or whatever, that have kind of taken over that space and
spaces have
view
gone
those
dark.
as kind of outposts that they can put out into the community. So there is
Conversions
that
are up significantly
Yeah.
over last year. It's a greater portion of construction activity is conversions, and it's both cost savings potentially, but then it's also the location. A lot of those end up being retail, like Mike was talking about, the Kmart or others like that.
Yeah. And I think it's the opportunity if a center has gone dark and has a stigma in the market and it can be converted to a different use type. It's not necessarily that they went there for the retail. It's just there's an opportunity, with the square footage, that can be had at a good price.
Mm-hmm. Yeah. Okay. Yes.
Hi, Kelly with Midwest Realty. Ben, you mentioned something, and as a leasing professional, I was like, ooh, that would be so nice to be able to get that. We talked about the 4% spread, the 4% growth rate across it. And Eric, I have to say, you said tenants that are willing to pay those rents. I don't really come across tenants that are willing to pay the increase in rents, but you tell me who you're working with. But Ben, when you look across your portfolio, do you put different strategies together when you're dealing with the primary care, which, as you would love to increase their rents, they're getting compressed with their reimbursables, correct? Your plastic surgeons all day long, dermatologists, yes. Do you put different strategies together when you're looking at those type of renewals for the doctors?
Yeah, I think it's focused on each location and the strategy for each building. I mean, we might have a provider, I'm just going to make up an example. If an orthopedic provider wants to expand in a facility and we've got primary care there that wants to stay in at a below market rate, and we've got orthopedics that's wanting to expand and willing to pay market rate, then that would be a situation where we'd say we want to get market rate for the facility. But I think, like most folks, we don't want to just sit on dark space, right? And we want to make sure that there's the right health system, that there's the right ecosystem amongst the health providers within the building. So sometimes it can make sense to say, let's keep someone who may not be able to get fully to where we think market is, because they're a piece of the puzzle that's helping to drive the ecosystem and volumes to the rest of the tenancy within the building. So I would say each case is nuanced. It's not just a blanket, this is what we think the rate should be in this location, or this is your service and therefore you get this rate.
Awesome. Thank you. I'm just making sure all the landlords heard that too. Correct. Thank you.
Okay. All right. I think we're bumping up against time here, but
Yeah.
you want to go ahead and close it out, Hilda?
Yeah, well, I think we have a networking break now and then another panel coming up, I don't know, what is it, in 30 minutes?
Thank you all for coming, and thank these panelists here. Appreciate their insight. Thank you, sir. Good job.
Thank you.
Yeah.